Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
I could turn the curve to the side. So if I was bullish on a certain asset, let's say the U.S. dollar Canadian was dropping. Well, today maybe it closed at 106, wherever it did. I think it was actually close at 105 today, 105.06. The probability of it going up or down tomorrow, according to options theory, is about the same. So even though we might be in a bull trend or a bear trend, according to technical analysis, the options market really doesn't believe in that technical analysis. They believe in the distribution, the normal distribution, and you see that curve turn to the side there. I hope that help you understand how these options are priced a little bit more. It's just as likely, so you might see the call puts going to be pretty close when they're at the money. Features of the ISE FX options. They are options on exchange rates. They are U.S. dollar based, 50-cent strike prices. The premium is quoted in U.S. dollars. They are European exercise. They're cash settled. Noon settlement on option Friday. That's next week. They are settled at the Reuters WS. And you need to have an account at an equity options broker. If you have any questions on that, you can send me a quick email, smeizinger@ise.com. I'll show you my email at the end of the presentation, and I can help you with brokers. Continuous two-sided market makers, quotes, and the trading hours are 9:30 to 4:15, although we're hopeful that we're going to 7:30. That'll, of course, at some time in the near future. Current ISE offerings. So the symbol is really important because as you trade, you're going to need to type those ISE symbols. So AUX, DPX, CDD, EUI, YUK, PZO, NZD, SKA, or SFC. Those are the U.S. dollar base. We have 4 that are U.S. dollar quote, which means that the dollar is in the denominator or the quote currency. AUM, GBP, EUU, and NDO, and if any of you have ever traded the spot currencies, really the spot convention right here. So I'll just put an S there. So that's more of the spot or the cash market. But for those of you that are not trading spot, you can trade AUM or AUX, DPX or GBP, either way. One, if you're bullish on the dollar, let's say DPX, you would see it going up. If you're bullish on the dollar GBP, you'd see it going down. All right, let's get back to the pricing inputs. Jake asked me this just a second ago. The ISE exchange rate, the strike price, time until expiration, the risk-free of the base, the risk-free of the quote, and volatility. That's what goes in to your options pricing calculator, whatever you use. I mean, I use the live vol calculator. It's really a wonderful calculator. But you know what? There are many, many calculators out there. We have it at the ISE. You can go there. Helps you understand the risks of buying and selling an option. At the end of the option's life, an option is going to be either worth 0 or its intrinsic value. So it's the relationship between the strike price and that ISE pair value that's going to determine the cash value. How do we measure each and every day when the underlier is moving? Let's say the U.S. dollar is moving. So we're looking at the Aussie versus U.S. dollar. We want to know how much, if I'm long an AUM call, what would I be, how much of a benefit am I getting from that Australian dollar rallying? Well, that's called the delta. And I measure that 1 unit change. Let's say in the Australian dollar, US dollar might be a 50% or a 60% or a 90%, 10%. It depends on the strike price that you select. So the strike price, the out-of-the-money options, the deltas are lower, meaning the changes are lower, but the good thing about those out-of-the-money options, they cost less. Option strike prices are similar to insurance policy deductibles, differing risk-reward for different strike prices. Time is money when you're trading options. So if you buy a long-dated option, that's going to cost more than a short-dated option. If I knew I was going to be right, if I was 100% certain, which again, I'm not 100% certain on anything, but if I was, I would probably buy a very short-term option. What I like to remind investors is you might want to give yourself a month or two more than you think you need so you have enough time. Time decay is measured by what's called theta, and that helps you understand how much your option will decrease in price. If you're long, nothing happens. There's also another term called gamma, and that tells me how quickly my delta changes. My delta tells me how much my option is going to move up or down based on the underlier. So gamma is going to manufacture the delta. If you want to learn more about all that, come back to the class, the Option Greek class, and that's coming up very, very soon. Options have value for two reasons, because of volatility and the interest rate differential. So if I didn't have any volatility, well, all options would trade at their intrinsic value, essentially, if there wasn't any interest rate. But we do have interest rates, and we do have volatility, and that's why you'll see option premiums. When I say option premiums, something different than the intrinsic value. So if I'm looking at AUM trading at 89.11, the 87 call, in most cases, is not going to trade at $2.11. It's going to trade more than that because there's a bit of volatility in there. There might be a little bit of interest rate. If I want to look at the interest rates, well, it's the exchange rate plus a put, and that actually creates what is called a synthetic call. So the interest rates really, they do matter. Interest rate differential is very, very important in FX options. Calls and puts reflect interest rate expectations. Theoretically, the exchange rate should decline by the amount of the interest rate differential. Remember the carry trade? And I'm sure a lot of you remember this, where you would invest in high-yielding currencies. Well, according to, I guess, higher finance textbooks, that carry trade really shouldn't exist. Because in theory, if a currency is paying you a higher rate, there's more risk to it. In fact, at least in theory, it should decline by the amount of the difference in the interest rate. It doesn't always work that way, and that's why we have carry trade situations. So if the base currency has a much higher rate, the puts will reflect that. Meaning, if you look at AUM, the puts are going to be higher relative to the calls. The base currency has a much lower risk-free rate. The calls are going to reflect their pricing with higher values relative to puts, AUX.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.